Welcome, everyone, to the Colony Advisors July update. I am Brendan McCarty, CIO of Colony Advisors. Thank you today for joining us on this call, this presentation on our strategies and on the markets. For more information on Colony, you can go to colony.com. You can view us on LinkedIn, see us on Twitter, and in other mediums. Thank you for joining us today. There are three themes at Colony Advisors that we see at the moment that reflect through the markets and through our models. First, volatility is rising. It's rising beneath the scenes, if you will. It's not rising day to day, as the day-to-day movements seem to be one directional and up for stocks over the past few months. However, underneath the scenes, you're starting to see a little ebb and flow. We haven't seen some good ebb and flow in these markets since the November elections for the most part. There was a nice choppy trade in October of last year. November occurred and it's been a one-way train to the upside. This one-way movement has depressed volatility as investors basically jump on it and follow it higher, buying every dip, whether they're one-day sell-offs, 15-minute sell-offs, 30-minute sell-offs, whatever the sell-off is, the buy the dip crowd is live and well. However, starting in May, we started to see volatility creep up a little bit. And that led to some better trading improvement for our strategies. June, it settled back a little bit, perhaps people going on vacation and less trading. And then July picked up again. And we saw some good, very good ebb and flow. Typically speaking, when this starts to perk up after a very dry spell within our models, this portends well for our strategies going into the fall. So we're actually very optimistic on things going forward in terms of our strategies. What may have precipitated this jump in volatility was commodity movements. So everybody knows what lumber has done. It went up and went down like a crazy rise and a roller coaster ride. This movement, not just in lumber, but other commodities, we believe, has factored through to other assets. As we all know, in this world of connected assets and connected global economies, when one thing goes up and then drops like a stone, that is going to ripple through to other markets. Several commodities did that. Crude oil went up to 78 and dropped to 68. Currency movements even started to move a little bit. You saw the yen go up to 110. With all this movement, we started to see equity volatility pick up a little bit. Treasury markets made new lows and bounced a couple weeks ago. Last piece is the domestic and the global economy. So with the movement in commodities, we saw a shift in demand in the asset world that led to supply chain shortages everywhere. This slowed growth globally and created uneven growth. However, we're starting to see growth pick up in spurts, in part. We saw a jobs report that was very big and very solid last week. However, we've seen surveys where inflation is becoming an issue for the average day consumer. A 5.3% consumer price index year over year is not a great number for the Fed. However, right now, the Fed does not believe it's sustainable. With COVID, the Delta COVID in play, this very much could be a case. We don't believe that. So how does this relate to our strategies? Well, as we said, volatility was dormant. It was dormant through May for the most part. But as that volatility picked up in May, our trading opportunities became better and our accuracy became much better. When the accuracy picks up, that usually means the market is transitioning. In July, we had some very good ebb and flow. Trading results were very good as a result, and that gave us an up month. The one fly in the ointment here is the trend of the market remains overbought, and we're out of the trend component right now, not chasing. The reason for this is we don't want to be there when the market reversal occurs or when that 1 month correction occurs. Typically, markets that move this way, and they've only moved this way 3 times in the past 50 years, we've seen a correction back to about the 65-week. That currently resides down near 4,000 in the S&P, argues for about a 10% reversal before the trend reasserts itself. What would kick that off? That's tough to say. Earnings would have to be an issue. The Delta variant is becoming an issue, though most traders at the moment seem to be ignoring it. Sentiment was an interesting development in July. It actually weakened throughout the month, even as stocks rose. What do we chalk this up to? We believe that institutional investors are getting defensive again. You've seen volumes dry up in August, with retail the only ones trading, it appears. And that could be they de-risked going into the end of July, the institutional investors, and that's why sentiment weakened. It almost weakened to the point where we would actually put a buy trade on for this market if it had continued, but it moderated as the month ended. As we said, we had limited but successful opportunities in July, and this created profits for the strategies across the board. 2 out of 3 months, we consider a turn for these investment strategies after 6 months of being very, very quiet. We saw decent returns from February through the end of October last year in 2020. We believe we'll see a pickup in these better performance and better behavior. It may not translate to substantial profits and returns, but we like the behavior. And usually when we have better behavior, that leads to better returns. As for August, we have been on the sidelines since the month began. August is a very unpredictable month. It suffers from lack of liquidity in many cases. And given what we've seen lately with this, like the likes of Tesla and Bitcoin, it's usually the retail investor the only one around. So movements are not great. Risk management is not great. That's why we go to the sidelines in this such case. Couple interesting charts we've seen since we started reviewing things. First is the Nikkei 225. It has put in a reversal, and if you happen to notice, it's occurred from February. The Nikkei put in the reversal in February. The global economy started to have issues a couple months later. The yen also reversed those highs. What does all this mean? It means this is an indication that COVID is impacting things in the Asian markets. However, it also means it's a shift in risk. One common theme that we talked about this past Monday on our Nucleus call was that investors are moving out of China and into the United States tech. Now, United States technology has had a huge run over the last 18 months, dramatic, large returns. China has given up much of those returns lately. That's why investors are running into the United States as a conservative play, as a relative safety play. The Nikkei may be representing that. They're running out of the Nikkei and moving into other markets like the US. Is this sustainable? We shall see, but we're watching 26.5 as a very key level for the yen, for the Nikkei. If it breaks that level, we believe the uptrend for the Nikkei is over, and a much more sustainable drop will come into play. Second most interesting chart that we found is the price of Bitcoin with the price of the US Select Home Builders Index. What this could mean, and we're just speculating, is the rise of crypto that inflated a lot of people's wealth drove into the price of home building. Basically, people use their Bitcoin, their Ethereum, and others to buy homes. The chart is uncanny how close they have followed each other. What this means is, with Bitcoin now taking off again this month, does this mean the housing market's waking up again? That would actually make sense to some regard because rates have plummeted so much. So it comes back to the fact is the correlation with Bitcoin and rates? Tough to say, but we are watching all this very closely. A rising housing market has been a buoy for investor wealth. We've seen 20% down payments drop to under 20%. We've seen 5%. We've seen a lot of speculation in home building as well. So if this were to continue, it could create an imbalance in the market similar to the early part of this century. Longer term trends. As we mentioned, we believe this is all leading to more normal behavior for the algorithm, for the markets. More normal behavior is wonderful for trading. It has a nice ebb and flow where we see we get good opportunities on both the long and short side. And we also see our trend piece follow the primary trend and work within the markets. However, with the long-term trend overbought, this is the third most overbought market in 30 years. What does that mean? Well, as an overbought market becomes more overbought, this could lead to a wicked reversal of sorts to correct that condition. We believe August should be interesting. So far, we have not seen a reversal. We've seen a little volatility, but a little volatility does not indicate a trend is changing. So with that said, I want to thank you for joining us with the July update of Column E Strategies and the markets. Please, again, you can follow along with us at columne.com. We will be going live every Monday now, starting with Nucleus calls on Open Exchange Television. There you can get the latest updates in terms of market views from yours truly, and with Nucleus 195. Thank you very much for joining us today, and have a great day.